session number 5. And, the first thing I want to acknowledge and just talk about, although I am going to give more of a formal, feedback to you sort of outside of our time together, because there's too much there, is you guys did the innovation project, right? Like, great job. So give yourself a round of applause, right? The innovation project. You guys got together, right? I talked to you guys kind of offline. You guys all got together, talked, worked through this project together, and came up with a great concept and idea. And so I just want to acknowledge that. And I was having a good time going through it, having fun. And so I'm going to give you guys some formal kind of feedback, some things to think about, and all the great things that I saw you guys do. So great job. And I think you guys had probably a good time connecting with one another, working on that. Is that safe to assume? Good. Cherish those relationships. They'll go with you for the rest of your days. Okay. So I'm glad you did that. So good work. So I guess the first question I have is, when you went through the industry overview, was there anything that stood out to you at all, or anything that you remember just about the industry, the statistics, concerns, questions, things like that? Just about the commercial industry as a whole.
I think I didn't realize how big the industry was.
Mhm.
Industry is large. To think that there's so many people that are, I guess, competing for the same clients is kind of interesting, because you really have to have something different, that draws them to you compared to the other competitor.
Yeah. Yeah, it's a massive industry. I mean, it encompasses everywhere. I mean, you can't really drive around town and not be bumping into this industry. It's all over the place, multifamily, office buildings, retail centers, you're going into restaurants, you're going to the grocery store. I mean, all this stuff are people that put tenants in locations that function a business everywhere you go. So it's a massive, massive industry for sure. And at the very same sense, this is a little bit ironic, but it's also a very small industry about the people that operate in it. It's a massive industry with billions and trillions of dollars, but it's a smaller amount of people that dominate a tremendous amount of real estate. And so that's just something that you're going to find if you choose to go in this industry, that you do have to have something that is distinct and unique, and you have to be ready to bump up with sort of the big boy pants. It's just, I mean, there's just a lot going on in this world that you have to be prepared for. And it's fast, and it's furious at times. I was just on the call with a project we're closing in the next 2 weeks, $150 million. And we were having some tough conversations about things that, the lender was having problems with, and the client was, and we were having some tough conversations on the phone, trying to work through things, solving problems. And it is definitely different. You'll never be bored. So what else? Any other thoughts, comments, concerns?
Like what Shioma said, I feel like when I was looking through and seeing like the size of each deal, like just how giant they were, it really impacted me in the sense that you have to make sure that everything, is done correctly. And, being able to provide, like, for example, the goal of um, maybe doing it faster than other people, like getting the loan all settled. I feel like it's really interesting how, careful you have to be and make sure you do everything right.
Yeah. Yeah, you definitely, and what you'll be surprised about is on these large loans, how much people are not. I mean, or just how long it takes for someone to figure something out. I mean, on this particular project, there was a disclosure of what they call the capital fee that was going back to the developer at close all the way at the beginning of the project. And then they didn't really discover or start to underwrite it till way later, and we're several days from funding. And then this $600 and some odd $1,000 thing comes up, that they start saying, hey, we have a problem with this because we realize this is going back to an affiliated entity that you still own, and we don't like it, right? And so, these are things that were disclosed up front and pretty thorough, but you still have people that don't pay attention, right? Or they don't really pick it, or hands off to the next person, and then they don't really know. So yeah, there's a lot of thinking through things. And that's why what we do is really focus on being proactive, is digging into those things up front to try to address them. But even then, stuff still goes haywire at times, right? We still go back and go, gosh, where did we miss that? What happened? In fact, I just was going through, before I was on the phone with you guys, I was typing out what happened. Whenever something goes haywire, I always try to stop and write out, like, what happened? Did I miss something? What's the potential solution in the future? Like, what do we need to do to change? I try to make that a habit, right? So you don't keep doing the same thing over and over again. So good point. What other thoughts? Any other comments, thoughts?
Thought the amount of land, they said like 85% of land is owned by ranchers and oil companies. That was, in my mind, just crazy. I still can't wrap my head around that.
It blows your mind, doesn't it? Wait till you start really drilling down and find out how much land is owned by how many people. And it starts to get really fascinating, where you're like, wow, there's this much land owned by small amount of people. And so you just realize, man, there's just, it's a crazy number to try to figure out, like, the land mass and how people are trying to develop stuff and redevelop things. And so it's a huge part of what we do. So good comment. So it's good, guys. It's good for you to just, again, the part of the reason I'm trying to unpack this for you is you can kind of see the scope of this industry as you guys are making decisions. Like, is this really an industry that is going to be around? Is this kind of going away? Is this large enough for me to really build a career around or not? And obviously my, response is yes. It might change, and there'll be definitely a lot of nuances, but it's here and it's not going anywhere. It's just a very complicated, difficult thing to kind of get your arms around. And it's here, it's everywhere you turn. Okay. So, did any of you guys, I know some of you kind of probably didn't have a chance to call any of the banks, but did anybody get a chance to do that?
I did it earlier today. Yeah, I was able to get on the phone with Frost Bank.
Okay.
Yeah, I mean, they were super reciprocal. Like, it wasn't, I got transferred through like 3 different people, but
Sure.
yeah, it was just like quick little insight. Obviously, there were some things that I had no clue what the heck he was saying, but it was still cool. Like, the guy was super awesome and nice about it. Said if I ever needed anything to call him.
And how did you learn anything new? Did anything stand out to you when you?
One thing that, like, I mean, I kind of knew this already, but he just said like a big part of like their business is like relationship based. Like, if you look at like some of the great recessions over the last like 30 years, Frost like went up during them, and it's because they built those strong relationships. So kind of like an emphasis on that is kind of what the guy said separated them from other lenders.
Yeah, it's good. Yeah, if you guys get the chance to talk to banks, a bank really, if you think about it, they are this government oriented entity. And I don't say that lightly, because they are regulated by the FDIC and the OCC with heavy regulations. Okay. Because, deposits go in and they can insure that up to a certain amount. And then what happens is they're taking this money in and they're basically trying to lend it out at X amount of dollars higher than what their cost of capital is, right? So they're kind of taking in obligations, right? You and I are kind of putting money in this account. They're taking it as an obligation on their balance sheet. That's what it is. It's an owed thing back to you. And then they get the opportunity to lend that out to other people for a higher amount, right? So it's all of a sudden it comes in at X, 3%, they pay nothing, right? It's point something, but their cost of capital, because they have to operate a business, they come up with this number, takes all these little costs in and comes up with this number that ends up being their cost of the capital in a unit basis, right? Or a margin or a rate. So let's say their cost of capital for them is 3%. Okay. Sometimes they borrow money from the Fed funds, or the overnight bank will lend money to them at X. And then they lend that out to you and I for 6, right? And then they're making this margin above what it is their cost of capital is. And so they're constantly managing that between fees and that to determine whether they're going to be profitable or not. Okay. That's why banks only like to do like 3 or 5, 7-year fixed max, because interest rates are getting so wonky. They don't want to lock too far at this rate. And all of a sudden market rates are here and they're upside down, right? They locked in at this, market rates are this, and they're technically losing money because they have a net economic loss, right? They could be making 7, they're only making 5. And so they're always managing those interest rate risks. And especially right now, when the interest rate environment is so wonky, they won't even commit to a rate until you get to close, right? The Fed funds came out today, right? They're like, we're jacking it up 3/4 of a point, right? Powell does. So, and that's probably going to happen again. I mean, they're probably going to go up another 3/4 of a point, if not a point, right? They're just going to try to cram us down to 2%. It's not a soft landing. So ultimately what's going to happen is banks are always managing this kind of stuff, managing risk and interest rate risk. So they take the money in, they lend it out, and every bank you walk into, I could literally tell you what they're going to say. I've talked to so many of them, and they've got it pretty pared down. We're a community bank, we're a relationship bank. And, they love to do owner occupied stuff. Why? Why do you guys think that they want to have the small business owner as their client? Any ideas? Versus the investor. So here's investor buying properties, and here's small business owner. Why do you think they would choose the small business owner over the investor?
Are they less risky?
Yeah, there is that potentiality. Historically, there's less risky. So that is a possibility for sure. What else?
In a sense, it might be easier for them to know who they're dealing with. You get these like large scale investors, it could be difficult to kind of really know who you're working with.
Yeah, for sure. Right. Like you're saying, hey, I deal with you more regularly. You're dropping deposits off. I'm seeing you. I'm coming out to your operation. So there's definitely, potentiality for that as well. What else? What other reasons do you think they want the small business owner? Why don't you guys always go ahead?
No, I was going to ask if it has anything to do with collateral.
Yes and no. So let me try to unpack that. And I want you guys to think, I'll pivot off of that comment. I want you guys to think this one word is what you're dealing with in every single transaction that you're dealing with, and almost every single step that you're dealing with is one word: risk. Risk, 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 risk. They're constantly asking the question. It's pounded in their head all the time. What is the risk and how am I going to mitigate that risk, right? If somebody's local, that's less risky for them, right? Because they can go see them. They know that they're in their backyard. It's just there's more risk there, right? Because they're local. Their reputation's on the line, right? So there's less risk. If I'm a small business owner and you are lending me money, then guess what? My primary generally speaking, income source is coming from my business. So I got a lot on the line to make sure that this thing works. Okay. So I'm probably going to bend over backwards when things get tough to make sure this thing works, because I've got kids and food and household and all that stuff. So I need to make sure that this thing functions. So my investment factor goes up tremendously, right? I'm more vested in that thing versus if I have a income property and that doesn't quite work out, you know, no skin off my back. Maybe I work somewhere and I get my income. It's like, hey, I'm going to let it go. You know, that's not good for my credit, but you know, so what, right? So it, you know, at the end of the day, there's just more risk and there's less likelihood of default. Historically, that's proven, by the way, just through, if you look at the stats, okay? Small business owner just way less likely to default than an investor, okay? The other reason is this thing called deposits, okay? And banks love deposits. That's what they're in. If they don't get deposits, they don't lend money, which means they don't make money, right? So they need your deposits in mind, and that's what they're looking for. So guess what? If I get banked by a bank, then I'm putting my money in there and they're recycling that, right? And they're using it to continue to grow their balance sheet and their income statement. Does that make sense? Okay. Bankers are pretty conservative. I literally could tell you, I've talked to so many banks, I could just already tell you what they're going to say, probably how they're going to underwrite, what they're going to look at, how they're going to look at it. They just have a way they see things because they've been trained to see that way. Okay. But banks do a big portion of the business within the whole economy. They're a tremendous portion of the economy. Okay. So does that make sense? Okay. Any questions around the kind of the banking position? And remember, when you deal with a bank, you're dealing with kind of what they call the BDO or business development officer, originator. They're out there selling, right? Let's go get business. Then you come in and you're dealing with more of the underwriter, right? They're kind of looking at the numbers. Then you're dealing with a chief credit officer, which is the one that kind of makes some of those decisions for the underwriter. Underwriter preps it, goes to chief credit officer, makes decisions of whether this thing is going to go to committee. Then it goes to committee, right? And you have either a handful of people or a big committee, a board of directors that kind of go in every week and say, hey, yes or no, or yes, but we need to do X, right? So you have these different positions, and it's really important when we deal with banks, we need to know, like, what is your process, right? Because think about it, the more layers of people that have to approve it, what do you think is likely to potentially happen?
The longer it's going to take.
Longer it's going to take for sure. And the more potential what?
The better, like the better the deal, just because you'll find any issues that might come up. The more eyes you get on like the final deal, the better it will be.
Yeah. Well, and there are more problems you're going to potentially have. If I'm the borrower going to that bank, I have more potential aspects of somebody kind of saying, well, I don't think we want to do it. There's just more hands touching it. There's less communication that goes to that pipeline. And also there's less risk. If I'm the guy that never met you and I'm back in Wisconsin and you send me a file and you're just a piece of paper to me, right? So I'm like, yeah, you know, whatever, I'm going to decline it. And you never know why. So it's just the more layers you have, the more risk, because it's just, there's so many hands touching the file. And that's what we've seen. And we always vet that out because we don't like a lot of red tape. It just causes more likelihood of a deal blowing up. Does that make sense? Yeah. So just something to kind of think about, that we vet out banks. We have a very certain criterion that we go through to make sure we want to work with somebody or not. And a lot of them don't fit just because we want to deliver an experience and to the client. And so we have to be real careful. Okay. Okay, so did you guys get a chance to go through the life insurance companies? Did you guys get a chance to go through that? Okay. So how many of you thought life insurance companies lend money? What are you talking about? It's crazy, right? I mean, you just go, wait a minute, MetLife and New York Life and, Standard Life and, Geico, like, MetLife, just on the phone with MetLife the other day, and so think about it. You and I pay these insurance premiums every single month, and you don't think that they're going into this big bucket, and somebody is managing that money. Okay. They're called the chief investment officer. They're managing this money. They're like, what do we do with it? Because they have to be careful. Why do you think they have to be careful with it?
Because they'll have to pay it back out if someone gets, hurt or dies. So they can't lose it.
100%. Hurricane, massive thing happens, right? And all of a sudden, big claim takes place. And so there's all this money. And if they're not careful to manage that, right, they could just all of a sudden not be able to issue out money on claims. So they have to be real careful about the way they disperse that. They're going to invest in bonds and different things, managing that money to make sure they're making money on it, but also minimizing the risk. Okay. And so what they do is they'll peel out this little department and do mortgages, commercial mortgages. Okay. And do you guys remember what I talked about as to what those people were called that they utilize in local markets? Do you remember the name? Starts with a C.
Correspondent?
Yes, correspondent. That's right. So what was a correspondent?
They have exclusive rights to market commercial loans in a specific region, I believe.
That's right. Yeah, that's right. So they're given that certain segment that they get to go ahead and disperse the money, right? And actually they'll service the loan. So they'll actually go through, they get it approved from the life company, book the loan, they'll service it, means they collect the payments, right, through the servicing. And they're the ones that go out and do the inspections every year. So they are like an arm of the life insurance company all over the country. So there's certain correspondents who will represent that life insurance company, or maybe multiple. Okay. And what were life insurance companies all about? What did they like to do? What kinds of deals were they into?
Term fixed financing.
Long-term fixed financing, is that what you said? Yep, 100%. So they like to do long-term fixed financing. And what kinds of assets do they like to do the long-term fixed financing on?
Retail, office, industrial, multifamily, and the like.
Yeah, exactly. So they just kind of what we call the forward food groups, right? Just office, retail, industrial, multifamily, right? These are just the buckets of money that they like to go after. And, they generally, do you guys know what I mean when I say loan to value? What does that mean?
Like how much of a loan they're going to give you versus like the total value. So like, let's say if it was 80%, you would have to put up 20% and they'll give you 80%.
Correct. Exactly. So purchase price is $10 million. They say we'll lend you 65%. How much are they going to lend you?
6.5 million.
6.5 million bucks, right? So life insurance companies tend to be very conservative. So they're not going to max leverage typically. They're going to do like lower leverage. They'll give you a better rate than you'd get at a bank, and they'll fix it for longer, but they want to set it and forget it. Okay, they want to just put it to bed. So they're going to have a really, really steep, hefty prepayment penalty. Do you guys remember what that prepayment penalty was called? It's something that you guys are going to love to say around campus because you're going to be so smart and you're going to tell people, say, do you know what this means? Yield what? Remember? Yield maintenance. YM, yield maintenance. So they have a prepayment penalty that's called yield maintenance. Does anybody want to take a crack at how you explain yield maintenance? If you do, man, you're amazing, but it's okay because it's a hard one. So it's a very, very steep prepayment penalty. Do you guys even know what I mean when I say prepayment penalty? What does that mean when I say prepayment penalty?
If like you're paying ahead of schedule, you're gonna get hit with like a extra fee, like a pretty big one for this industry, because like they don't want you to pay up early, so because they're relying on those cash flows down the road.
Yes, 100%. Yep. Yeah, if I give you a hefty prepay, it's because I don't want you to pay me off, right? I'm trying to make it difficult for you to pay me off because I don't want you to do it. I want to keep the money out, and I want to just get my coupon payments every month, and just and so in order to do that, you essentially want to make sure that there's some level of compensation for that, right? Like, I mean, they're going to say, well, why would I go with you if I'm going to have to pay such a high prepayment penalty, right? So I'm going to show you guys something real quick, just to explain this, because it's an interesting concept, okay? So let's say, for example, that there was let's just call it a $10 million loan, okay? And you're 5%, and let's say that you were, did a 10-year term. The way yield maintenance would work is that, let's say in 5 years, okay, so here's year 5, that you want to pay it off, okay? So somebody goes to you and says, hey, I want to buy your building for double what you paid. And you're like, done. Like, you can have it, man. I'm out of here. And so you go ahead and say, here we go, let's sell it. So what the lender is going to do, under the pretense of what's called yield maintenance, is they're going to say, because they're in the business of wanting to make their 5% for that 10 years, they're going to go out into the bond market, okay, and they're going to look at a 5-year treasury. Now, why the heck would they look at a 5-year treasury? Any ideas?
I mean, like,
I'm getting your brains going here a little bit.
I mean,
Why
you want to
don't-
look,
Go ahead.
you want to look at the yield curve to kind of see where the market's heading.
Yeah, so yeah, good shot at it, right? Now, here's why. So remember, it was a 10-year term, and they're paying it off in year 5. So if I want to make the same amount that I would make, I'm going to use an index to go off of. So I'm saying I'm going to look at the treasury market, because they consider that supposedly zero risk. We don't know if that's really the case, but that's what they say. So you look at the treasury market and you say to yourself, well, there's 5 years left, so I'm going to look at the 5-year treasury. Okay, you following me on that? Now they're going to say, we're making 5%. Okay, so 5% is coming in every year off of this loan. Okay, and you can see the payment, $53,682. Now they look at the 5-year treasury. What do they show that it is? Is it 5%?
3.
It's 3. Okay. So from their perspective, if you pay them off, are they in the money or are they out of the money?
They're 2% shy.
Exactly. They're out of the money. So they're basically losing 2% for the rest of those 5 years, because that money they have been making 5, and the 5-year treasury, which they would replace it with, is paying them 3. So they are deficient economically right now, 2%. Okay, you guys tracking with me? So there's this delta here of the 2%. So what they're going to do is they're going to say to you, okay, Chioma, you want to pay me off? Perfect. Here's how this is going to work. That yield maintenance is considered a make whole provision. It means that they want to be made whole through the whole thing. So they're going to take, let's just go down to, what do we say, month 60? Is that right? So 5 years, 60. So there's 9,182,000 left on the balance. Okay. So if they go down and say, okay, we're paying off at this moment in time. Okay. And there's this much left on the payment. Okay. So there's this much of the balance outstanding at the time. What they're going to do is they're going to say, well, if we're making 5 and we're going to make 3 now, then what's the gap? 2%, right? So they're going to say, we're going to take this multiplied by 2%. And what is that amount right there? How much is that?
183,000.
183,657. Now you go, that's a lot of money, right? That's a big number, right? It gets worse. How many years are left on the loan?
5.
So you take that times 5. So how much do they have to pay to get out of this thing?
5 million.
Almost $1 million just to pay them off. Okay. And you can kind of see, you go, well, wait a minute, Dave, what if this is like 4%, right? And you say, well, there's only one. And so now that goes down to like 459, right? And we say, well, what if it's 5? Well, no matter what, in either case, if it's either equivalent or higher, they'll always charge 1%, okay, no matter what. But you still want to be able to do that, you know, because it's like, that would be a lot cheaper. So you can kind of see the bigger the delta, the bigger the number, right? So, and as you get closer, this is kind of a weird formula, because as you get closer to maturity, what starts to happen? That shrinks, right? Because you have less and less and less time, but it could still be pretty hefty if what? The treasury is like, if there's a big gap, you could still have kind of a big gap. So that number could get kind of wonky. So they're trying to make it as difficult as possible for you to pay them off. And so, you know, they just have to be sort of understanding of that. So does that make sense to you guys? Guys are kind of like, dude, we have read so many things around school. Why are you asking us to think this way? You're crazy. But it's important to just notate, okay? Because again, you know, what happens is I explain this just like I did to you, to the borrower, usually 3 or 4 times. And why do you think I would do that 3 or 4 times if they've never done this? Huh?
So they understand.
Yeah. Like it's a pretty big oops if they get into
it's a lot of money.
They go, like, wait a minute. I didn't really understand this. Like, why didn't you explain this to me? Right. And then they want to murder Mr. Cotter because I just got him into this loan. So I explain this a lot, you know, to people. Is you really understand this? Does this make sense? And even when that happens, sometimes after 5 years, they call me up yelling, what the heck did you get me in? Right. And I'm like, well, we talked about this like 5 times. Right. So it's just something to be very cognizant of when you're dealing with these kinds of things. Okay.
So now that I have that kind of vision, the yield maintenance is that percentage that you pay. Is that what that is?
Yeah, it's basically the conceptual definition of it, right?
Oh,
So
okay.
that it's yield maintenance. Now there's people will say defeasance, which you hear on CMBS. It's the same concept. There's some little nuances, but it's basically the same concept. You know, you can go sometime if you want to if you're feeling like nerding out a little bit, you can go to defeasewithEase.com and you can literally, it's a little calculator, you can play around and figure out, gosh, that would be super expensive. So, so anyways, that's life companies, long-term fixed financing. They don't really do construction. There's a few of them that do it, but it's very rare. They just want to set it and forget it. Okay. And, put it to bed. But they're great to work with. They're smooth. Once they give you a commitment letter, it's just like you're going to a finish line, right? They're much easier, in my opinion, to deal with a bank. The bank is underwriting you as a person and everything else under the sun. They're also going to probably underwrite the person you dated in high school. I mean, it's just sort of that invasive, right? I'm kidding, but you get my point. They want to get into everything. Okay. And the life company is more focused on the asset and less on you. Okay. The bank is focused more on you and then the asset. Okay. It's a little bit backwards. They're really focused on you as the individual. And then they kind of say, well, this is nice. We've got an asset that we can underwrite as well. Okay. So it's just very income producing oriented, is very favorable to life companies. Banks are just owner occupied type of people. They love the business owner. It is their thing. Okay. So make sense? Any more questions about the life company? Now I've just completely ruined your minds about life companies. You're never going to see them the same again. Taking my money and lending it. Who do you think you are? Don't lose it. Okay, so let's end our time here together on CMBS. I know you guys will. Some of you have gone through this, some of you haven't, but we'll chat about it nonetheless. So does somebody want to take a crack at what the acronym is for CMBS?
Commercial mortgage-backed securities.
Good job. Commercial mortgage-backed securities. That's a mouthful. Okay. And so this was kind of I would say it's not new, but it's new work conceptually. Okay. People started securitizing things, home mortgages. That's where, 2008 was such a lovely time when we had all these mortgage-backed securities that went, haywire because people were lending way too high and to people they should have never lent to, right? And all of a sudden the whole world just kind of collapsed. But what happens in a CMBS is, does anybody want to take a crack at how does this mechanism work? What is this? How does it function? Anybody who watched the video want to take a stab at it and jump out on the cliff here for a minute?
Like basically like a lender bundles together a bunch of mortgages they've put together and sends it to like an institution to be securitized. And there's also like someone who like picks it up along the way to maintenance it through the maturity. And then that institution sells it to investors.
Exactly. Yeah, good job. Absolutely. So I want you guys to think about, I'm a simpleton in my mind. So you think about, you have this party over here, which is what I would call the originator. Okay. So you think about in your mind, Bear Stearns or Merrill Lynch, large, kind of national bank. And they have access to these huge lines of credit. Okay. And so what they decide to do is they say, well, we're going to go ahead and create this program and we're going to take it to the market to lend on not construction, but again, existing large commercial real estate properties, apartments, office, retail, industrial. Okay. So call it 10 million and higher. And they say, hey, we'll go ahead and lend you 80% of the purchase price. That's what they're known for, is maxing leverage. And then what they do is they'll bundle all these loans up. And what they do is they will then communicate with a rating agency. Okay. So the Moody's will come in and they'll take this big bundle of loans and they'll rate AAA, double A and B, all these things, right? They come up with all these different ratings based on risk and cash flow and asset type. And then what they'll do is then they'll price it and say, okay, go ahead and go to the market. And then there's these huge companies like life insurance companies, pension funds that will buy these security instruments in bulk, okay? And they'll go ahead and use them to make money, right? It's like kind of like bonds. And they'll just say, okay, we're making the cash flow that's coming off of this. We're making the money on this. And so what happens is they'll go ahead and say, well, we booked him at this price, okay, and we're going to sell them. So let's just say 100, and then they're going to sell them at 101, okay? So that means they're going to make this 1% spread on billions of dollars that are going in here, and then they're going to make the difference between those two. Does that make sense? So I'm just kind of giving you the simpleton version of like, this one books it as soon as they do, within 90 days, they're going to sell it off. And so they're only carrying it on their balance sheet for a short period of time with the intention of making money by selling it off. And so they're constantly communicating with the secondary market and asking the question, what will you pay for these? How would you price this? All the way through to the end of the origination on the loan. So let me ask you guys a question. Where's the flaw in this whole thing? Where could things go wrong? Based upon what I just described to you. They book this thing here, they bundle it up, they have to price it with the market to make sure they'll buy it so they can make a profit. They're expecting that the market's going to accept what they originated, and then they book all these loans and they're hoping that that happens. So where could things go wrong?
Maybe in the rating of the.
Could be the rating for sure. Rating could be off, right? That's absolutely a potential. What else?
The markets could go haywire.
The markets could go haywire. Good job, Chioma. All of a sudden, you think about what happened. COVID happened. And the markets just went, right? And just had like it's kind of like when you date in high school and all of a sudden you guys hate each other and then everything goes out the window, right? It's all completely a mess, okay? So the markets are completely a mess. And all of a sudden, all these people that were telling you will buy it for 101. And now they're saying, I might pay you 98 cents, okay? But I ain't paying you this, okay? And they're going, well, crap. We booked it at this price. There's nothing we can do, right? Except wait it out. Hopefully the market will come back, right? So, I mean, I've seen it to where we get all the way down to the end, okay, in 2008, and all of a sudden the 08 happened. And I get the phone call from the guy and he says, hey, we're not doing your loan. I'm like, what do you mean you're not doing my loan? Like, you booked it, like it's approved, like we're supposed to close in 2 days. You're crazy. And he said, I'm sorry, the markets won't accept it. We're out, right? And they just walk away. And it's like, well, you could sue us, but have fun. We don't care, right? So it's just so volatile, okay, that it's a really risky proposition to do a CMBS loan. I am not a huge fan of them. I've done many of them. We've gotten them over the finish line, but without fail, almost every time we get down the finish line, and they always do this little fun thing at the end where they try to retrade you. Well, we know we did this, but it's actually this, okay? And they kind of know they have you right here because they're like, where else are you going to go? You're out of time. It's at the end, right? There's a little bit of thing in the back of your mind going, all right, this isn't good business, right? So it's a weird area. It's big business. There's tons of them that get done. And certainly you could do well doing them, but it's scary for me because the client could just get bamboozled at the end. Okay. So does that make sense? Is tracking with me on that? Okay. Again, these are larger loans, 30-year amortizations. It's non-recourse. What does non-recourse mean? Do you guys remember?
You have to put up like an asset to back the loan to. And that's the only thing that like the bank can seize if you default. They can't take your personal property and stuff.
Booyah. Absolutely. They cannot come after you personally. There's no personal guarantees. You go to a bank, Ben, every single time the bank says personal guarantees, right? That non-recourse word is a swear word. They like, no, none of that, right? So non-recourse for CMBS is literally 100% of the time. So they're really focusing on the asset, okay? And so they'll do non-recourse loans, 30-year amortization. They do interest only too. People like it for that. They'll do interest only for like 5-10 years. Banks will never do that, right? That's just not going to happen. And so there's just lots of reasons why you'd want to do them. You don't have the same risk. You get interest only, but you know there is a risk that the thing could blow up at the end. Okay, so I just wanted to kind of give you an overview of that for today. We're kind of coming up to the end of our time, and so any questions about that before we'll revisit a little bit next time. I don't want to rush too much, but you know we're out of time. So any questions about that?
Would you say that the majority of the deals that you do are with life insurance companies, or is there one that you tend to do more deals
Yeah, I
with?
would say it's a kind of a combination between life insurance companies, pension funds, and then what I would call non-bank construction groups. So there's large groups that will do construction financing that are not banks, essentially. So I'd say that's probably the bulk. We still deal with banks. We like banks. I mean, they're, you know, it is what it is. There's nothing fancy about them. So, you know, creative and bank don't go in the same word together, but, you know, they do what they do. So good question. So here's the deal for next time. I want you guys to write a 50-page dissertation on hard. No, I'm kidding. You guys are like, oh my gosh, this guy's insane. So see if you can get through like hard money lenders, bridge lenders, third-party reports. That one's really easy. Clients you'll work with, and then your role at Integrity Capital. Okay, it should give you through the weekend till Monday, but let's try to knock that out. So we'll have some discussions around that on Monday. Okay, and again, I will give you guys some feedback. I'll try to do this over the weekend on your project. I'll let you guys know, like, hey, this is what I really liked. It went well. I'll give you guys some feedback on some things I would make suggestions about, trying to help you guys maybe on some presentation stuff and how you would clarify that just for future, just so you can get some value out of that as well. But you guys are awesome. You guys are doing great. I'm really just want you guys to know you're working really, really hard. And I'm thankful for you guys. And I know this is a lot to take in, but we're here for you however you need. And hopefully you're getting some value out of this. And so feel free to just, again, reach out if we can answer any questions for you. And we'll let you guys go back to your school stuff, which is so much fun. So good job today, guys.